Hello learners, in this video we will be talking about types of financial statements. The main types of financial statements are profit and loss account, balance sheet and statements of cash flows. Profit and loss account reflects financial results of business operations during an accounting period. Balance sheet reveals the financial position of the business concern at the end of the accounting period. And at last, statement of cash flows that shows the changes in cash flows of the business during the period. Let's talk about profit and loss account first. Profit and loss account is also referred as income statement or statement of operations. P&L account reports the results of operations of business in terms of income or net profit during the accounting period, usually a year. This statement mainly summarizes the revenues, expenses, and the difference between them, that is, net profit or net loss. Moving on to the contents of P&L account, there are three main contents. First one is income. It represents the incomes that accrue to the firm from trading and non-trading activities. Next one is expenses. Expenses means the cost incurred to earn revenues. And lastly, net profit or net loss. It is the difference between revenues and expenses. So, from where does revenue come? Revenue can arise from three main sources. First one is sales of goods and services, which represents the net sales revenue. Now, net sales is equal to gross sales minus sales returns. Gross sales is the total invoice price of the goods sold or services rendered. Returns and allowances indicate the sales returns by the customers and allowances availed. Next source is revenues from investments. It includes revenues earned in the form of interest, dividends, commission, royalty, and fees. These are the revenues earned by the business by supplying its resources for the use to others. And the last one is revenues from sale of fixed assets. It includes revenues earned in the form of sale of any fixed asset like plant and machinery, building, furniture, etc. Such assets are sold by a business only when they are not of much use in the business operations. Now, moving on to the other side of P&L account, that is expenses. Expenses are incurred to earn revenues. These include cost of goods sold, which further includes material cost, labor cost, and other manufacturing expenses like fuel, power, stores, repairs, maintenance, insurance of goods, etc. And the second one is general administrative expenses like salary, rent, rates, taxes, managerial remuneration, etc. Now, the last one is net income. Net income is the difference between revenues and expenses. Net profit arises when revenues exceeds expenses, and net loss arises when expenses exceed revenues. Net profit or loss is transferred to balance sheet as owner's equity. And at last, net profit is the link between P&L account and balance sheet. Now, moving on to balance sheet, that is also referred to as statement of financial position or the position statement. Balance sheet reflects the financial position of the business on a particular date, that is the last date of the accounting period. Balance sheet summarizes the assets, liabilities, and owner's capital of the business at the end of the accounting period. Now, moving on to the contents of balance sheet, there are basically three main contents, that is assets, liabilities, and owner's capital. First one is assets. These are the resources owned by the business measurable in money cost. The essentials of assets are monetary measurable cost, provides benefit in future by usage, and it must be owned, not simply possessed. Second one is liabilities. These are the claims of outsiders against the business. A part of the firm's assets are financed by the borrowing from the outsiders other than the owner, and these external claims against the business forms the liabilities. Liabilities may be long-term liabilities or current liabilities. And the last one is owner's capital. These reflects owner's claims against the business. In company form of business organization, the equity shareholders are the real owners. Their capital is called equity share capital. The owner's equity consists of two elements, that is, paid up share capital and retained earnings or reserves and surplus. Now, let's move on to the classification of assets. There are various types of assets. First one is fixed assets. Now, these refers to long-term resources of the business. These are held for more than one accounting period. Now, fixed assets are further classified into tangible fixed assets and intangible fixed assets. Tangible fixed assets are land, building, plant and machinery, furniture and fixtures, etc. That is, these are the assets which can be touched or seen. Next one is intangible assets like goodwill, patent, copyrights, trademarks, etc. Now, these are invisible in nature. And the second type is current assets. It refers to the short-term resources of the business. The current assets include cash, bank, marketable investments, accounts receivables, bills receivables, inventory including raw material, work in progress, finished goods, etc. Now, these are expected to be converted into cash within the normal operating cycle of the business. And third type of asset is investments. Investment refers to the funds invested in other companies. Now, these are long-term investments outside the business. And the last one is other assets. These include deferred charges, preliminary expenses, advertisement expenses. The benefit of these expenses will exceed the current accounting period and so acts as assets for the business. Now, let's talk about the classification of liabilities. The liabilities of business are classified on the basis of periodicity in two categories. First one is long-term liabilities. Second one is current liabilities. Long-term liabilities represent obligations which are repayable beyond 1 year. Sources of long-term liabilities are debentures, bonds, mortgage loans, secured loans from banks and other financial institutions, etc. Moving on to current liabilities, they represent obligations which are repayable within a year or operating cycle of the business. The main current liabilities are trade credit, short-term bank credit, tax payable, accounts payable, bills payable, accrued expenses, deferred income, etc. Let's have a look at the performa of P&L account. We can see that P&L account is a T-shaped account. That means it is having a debit and credit side. On the debit side, we will start with two trading account if in case there is gross loss in P&L account. And other items to be posted on two or debit side are salaries, rents and rates, stationery, insurance, interest paid, commission paid, discount allowed, advertisement, carriage outwards, bad debts, and depreciation. And moving on to the other side of P&L account, that is credit side, we will write by trading account if in case there is gross profit in trading account. Other entries to be posted on credit side are commission earned, rent received, interest received, discount received, etc. And at the end, if in case it is a net profit, we will write it on debit side, and in case it is a net loss, we will write it on credit side. And the last one is performa of balance sheet. Again, balance sheet is a T-shaped account which is having liabilities on left side and assets on right side. Liabilities have credit balance and assets always have debit balance. Now on the liabilities side, we are supposed to write share capital, reserves and surplus, long-term liabilities, current liabilities, and provisions. On the other hand, assets includes fixed assets, which is further classified into land, building, furniture, and plant and machinery. Another type of asset is current assets, which includes inventory, debtors, cash in bank, and other assets. And at last, there is fictitious assets. Now, there is a point to be noted that the total of assets and liabilities side always tallies. Thank you.